Okay, so back here with Clayton. How are you doing, Clayton?
Doing all right. Learning a lot.
Good. We're continuing the Buffetology book, and we were going to go through it part by part. We had it broken up into, is it 4 parts?
Yeah, 4 parts that follow the audiobook. It was 4 different tracks.
Okay, and if you have the book that you're reading, it should follow along pretty well. Clayton just went through and highlighted some things. He took notes as he went along, and we're just going to go over the most important ones or things that he had questions about, and we're just going to kind of review them. Maybe you guys had the same questions about them. We started talking about it last time, so we're going to just try and pick up where we left off. Okay, so we're at part 1. Somewhere around 21 minutes into the audiobook. And Clayton had some things that he had highlighted here. If you want to talk about them.
Yeah, sure. So I really like kind of the difference between what the Buffett way or the way the Buffetts and value investors would do versus the people on Wall Street or like the day traders or the all these other strategies that might be out there. And there was this like just line that Wall Street wants a quick kill. I thought that was really kind of eye-opening. That they're just, and by quick kill they mean like very instantaneous gains, even flipping, buying something and selling it an hour later for 1% gain or maybe a 1% loss. You don't know with the risk, but that they're in for the quick kill or the immediate return rather than the long haul.
Mm-hmm. And I think this is just human nature. If we see that we can get a huge gain quickly, then we want to take that. And I would say there's nothing wrong with that, actually. It depends more on your personality. And some people just have to be active and they want to be trading. If they don't feel like their money's working for them, then they feel like that they should just not do that strategy. So the long term, holding it for 5 years or 10 years doesn't work or doesn't sit well with a lot of people. So you kind of have to find the strategy that works for you. And personally, for me, I do value investing. But if I could see that I can make 5% return in 1 month, then I'll take that. And I take that 5% return depending on what kind of account I have. We talked a little bit about this last time, but if I have an IRA where I could just keep letting the money build without being taxed on it, then I find that this can be valuable to take the 5% return and then buy a new company.
Okay.
However, if you're being taxed on that money, you just have a regular individual account, then you have to consider that every time you sell, you're going to be taxed short-term gains. And short-term gains can be at your tax bracket, your normal tax bracket, and they can be much more than long-term gains. So if you sell a company in less than 1 year, you're taxed at a much higher rate than if you hold the company for 1 year or longer. So
yeah, that's all I think about.
yeah.
Gotta calculate.
Yeah, so first I would say think about the type of person you are, and if you're patient enough to just let your money compound and build and just hold one good company for the long run, or if you're the type of person that feels anxious and you're not very patient and you feel like you're going to want to just jump on that gain and take it when you can. So your strategy is going to be affected by what type of person you are. So what type of person are you, Clayton?
Well, I think instinctively, the reason why this quote stood out to me was because that was my assumption that you have to be, actively trading every day and, trying to capture that 1% gain, because that's what I see on TV, that's what I hear the talking heads, yammering on about. You see that's what's like in your face a lot.
Yeah.
But this distinction was really useful for me because I don't think I want to be like that, right?
Mm-hmm.
Like see these day traders on TV, you know, they're like sweaty and yelling, and that's not my style. Like, so I like the thing that was attractive about value investing to me was that it's you know, it's real, it's based on facts, and you know, it's not this rapid you know, like, or volatile situation. It's not like a casino where, you know, you're up 1 minute and down the next, or maybe just down the first minute and then out. That's not what I'm interested in. I want something that's slow, steady, and safe to a certain extent. But you know, I still prefer to beat the market and you know, maximize my gains, just not in a crazy, you know, everyday way.
Yeah, and I think this really pays off with when you're thinking of selling too.
Okay.
Especially if your company goes down, has a significant decline. So I'll give you an example. I just sold Exxon 2 days ago,
Okay.
and I had been holding this company for over a year.
Oh wow.
And
Exxon's just oil, or do they have gas stations too, or what?
yeah,
Okay.
yeah. So they actually refine as well.
Okay.
But, so anyways, I bought before oil had fallen in price significantly. I got it on the way down, but not way down at the bottom. And so I had to wait a pretty long time, like a year, you know, until it came back up to my selling point. But the advantage for me was that if I'm following value investing, I don't have to worry. I know that I bought a good company and I bought it at a bargain price, so I'm fine with holding it for a year or even 2 years or whatever. You know, I don't have to be anxious to sell it. Now that I sold it 2 days ago, okay, if the stock fell tomorrow by 20% and I bought it again, and then if the next day the stock went back up that 20%, would I sell and make that 20%? Yes.
Yeah. Okay.
Okay. So don't feel like you have to hold for, you know, a year, 5 years, or whatever. Take advantage. If you want to take advantage, and you already told yourself, if I make a 5% gain or if I make a 10% gain, then that'll be good for me, and that happens, then yeah, take your gain, whatever you desire to make initially. But at the same time, whenever you have the stock that declines, don't feel like you have to sell it.
Okay. Yeah, that's very helpful because I guess so. Value investing is a strategy, but yet when opportunity comes knocking, you have to be aware of it and recognize it, hopefully, so that you can take advantage of that.
Mr. Market.
Right. If he offers a crazy high price for you to sell at, then take it.
Yeah.
But so value investing is a strategy, and it's not like the only one that you can follow. You can do.
Well, it's still value investing because you're giving an estimated price of a stock, and if it's way over that, you sell and you take your profit. Or if it's way under that, then you buy. You know.
Okay.
So that's value investing. You're setting some kind of value, estimated value, and then you're selling or you're buying depending on where this price is moving.
Okay.
If it's over, even Buffett,
He'll sell a good company.
yeah, he'll sell it if it's way overpriced right now. So, and it might seem like this is contradicting itself, but just think that you're basically making a value, and then you're just selling if it's over, or you're buying if it's under.
This triggers a memory of like Buffett getting out of a company and then getting back into it later. I think there's an example. I'm sure there has to be an example that I can't think of the industry or company right now. But yeah, if it's way overpriced, he knows that very well. So go ahead and sell, and then if the price goes way back down again, or people are panicked for some reason, then he can take that opportunity up again.
Yeah, and I've done that so many times where I'll give Exxon as an example again. Like I sold it, then I buy it because it falls 20%, and then I sell it again after it goes up, whatever, 5-10%, and then it falls again, and I buy it again, and then I sell it again. So I'm just taking advantage of this price change.
Yeah. When we this is a little bit off topic for this, but you mentioned what type of investor am I, right? And when you were holding Exxon for a year, were there ever times that you considered selling so that you could jump on another company that maybe would have gained more during that time? How did you balance that out?
There can be times like that if you feel like the company, something bad is happening with the company, or you see this other great bargain. But most likely, I wouldn't sell at a loss. I try not to sell at a loss overall, because I know when I originally bought that good company at a bargain price that I made a commitment, and I was saying that I'm ready to hold this for 10 years if I have to, to make my gain. So I try to stick with that unless something really bad happens with the company that I know there's going to be a problem with it.
Okay.
But I'm personally holding around like 6 to 8 companies at a time. And so some of these other companies I'm selling, and then I can buy another company. So Exxon is not where all my money is, where I'm kind of stuck. And then if I see another company, then I want to buy it, but I can't. So, but if all your money is in one company, you might have more feelings to get out of that company or whatever.
Right. Yeah. So, it's good that like you've done your homework and you know it's a good company. Like you follow the value investing strategy and you know that it's a solid company. You've done your research. So
yeah, you have to do the homework in the beginning and buy at the good price. You have to do all that stuff in the beginning, and then you have nothing really to worry about. Even if it sinks down 50% or whatever, you just wait, and you're confident that it's going to come back up.
Good. So I like that. Wall Street wants a quick kill. Like if there's a quick kill to be had, then you can take that opportunity, like you mentioned. But I guess you don't always have to be actively trying to grab a percentage here or there all the time.
Yeah.
We're going to go to 27 minutes.
Yeah.
So it just talked about predictability being very, very important. And this stood out to me because, the stock market in my eyes is not predictable, right? Because the way that I've, witnessed it is just illogical ups and downs, based on, I've been listening to Mr. Market, I guess, and he changes his price all the time. So, that was interesting to me that there are things that you can make predictions off of.
Yeah, and being predictable, a company being predictable is one of the most important things for Buffett, because he wants to see that earnings are predictable and growing at the same kind of rate. This helps you to predict the value of the company and where it's going. If you type in J&J, Johnson & Johnson, and look at a chart for Johnson & Johnson over 2 years, 5 years, 10 years, you'll see that it's overall the movement is pretty predictable. And then you can look at some other company that might be like a tech company or something like that, or some kind of like growth company, and you'll see it's very volatile. So that's very hard to predict this company's value because it changes so much. So for value investing, you usually want a Johnson & Johnson that you can steadily predict the value of the company and the direction it's heading.
Right. The companies that you cannot predict, that maybe don't have the track record at all, they're like newer companies. You taught me before that you should just stay away from those, really, like if you're going to follow value investing. And I didn't realize, I never thought about companies like this before. before, but I guess companies, yeah, they go bankrupt. Like companies can go bankrupt, and
General Motors,
right
you
on.
know, look what happened with them, and
I guess they were able to overcome it somehow, right?
bail out. Yeah,
But,
but that doesn't usually happen with most companies, you know.
Right, right. But newer companies with a new technology, they could be here one day and gone the next. Those companies are more likely to go bankrupt.
Yeah,
right?
that's
a
riskier. Yeah, I
Okay.
would say.
And this is one thing. Like you talk about with value investing, you know, a company that you could hold on to for 10 years. Like you held on to for more than a year or a year with Exxon. But some companies do go bankrupt, and when they do, their stock goes away. Is that basically right? And you're out all like
Yeah, you lose your money.
you lose it all. It doesn't go back.
I mean, you might get some, but there's an order of debt repayment. I mean, like bonds, people that are holding bonds of that company, they tend to have the first position, so they're getting paid first. And then there's preferred stock, people that are holding the preferred stock get paid next. And then just the basic shareholders get paid last if there's anything left. So you're out of your money.
Okay. So with a good company, like a Buffett good company, you have confidence that the price will return. Like with Exxon, you had strong confidence that the price would one day return, and it took. Well, actually, a year doesn't sound that bad to me. Like
No. And I was getting paid dividends, you know.
yeah,
And
it's a good situation then.
yeah, and you know, if I make 5 or 10% return in 1 year and making dividends too, then like if you put your money in just a bank or in a CD or something like that, you're probably making less than that.
Right.
You know?
So this was an example of a small mistake or a not good situation for you, right? But actually, that seems pretty golden to me.
Yeah, I mean, it's just based on if you buy at a good price and buy a good company, yeah, then you don't really have much to worry about.
Okay.
And I don't want to scare people into thinking that like big companies like this are going to go bankrupt, because it's very rare. When it happens. But just know that there is a chance of something like that happening. So it's very important that you buy the best company that you can at the lowest price that you can, just to protect yourself.
Okay, good. Yeah, that makes sense. And those companies are predictable, so therefore you can feel good about.
It's easier to value them.
Okay.
Much easier to value a predictable company.
So you buy it at the right price.
Yeah.
Whereas a new tech company, all you see is 1 or 2 years of blips up and down, and
Yeah.
no.
Yeah. Or it could even be a company that's been around a long time, but it's difficult to predict because the price is very erratic, and you know it's just always going up and down, and their earnings are going up and down. Market values, when the market assesses a value on a company, it's based a lot on the earnings, and if the earnings are consistent and going up each year, then it's easier for the market to set a value for this company, and investors will kind of follow suit with this, and the price will increase, you know. But if the company is just like going up and down in price and earnings, you know, then it's going to be very difficult for an investor to choose the right estimated value for the company.
This is in part 4. It talks about this, but it's related to this. So if you have that very predictable trend line, but then very suddenly, like the ski resort that has a winter of no snow, and then for some reason the profit goes down. If you know that reason very well, and you know that it's
Well, then it can be predictable.
that is predictable.
Yeah, because some companies are cyclical and they have a pattern. So you know every third winter or every fall this company sells less of their product, you know?
Right.
So that kind of thing can be predictable, and you can look at 10 years and say, yep, every fall this same dip happens or something like that. So
Okay.
that can be predictable. Yeah.
Yeah, okay, so that makes sense. And a lot of people, they would say, they would panic during that time because no profits, and so that's actually a buying opportunity. Like,
Yeah.
if you're still able to predict and account for it. So.
Mhm. Yeah.
Okay.
So that's a good example. Yeah, so we talked about predictability
Uh-huh.
already. Let's look at yearly per share earnings.
Okay.
So this is one of the most important things that you can look at with the stock.
Okay.
Net income is also known as the bottom line.
Hmm.
This is basically the profit of the company. After they take out all the expenses and everything, they're left with the actual profit or the net income.
Okay.
Now, net income is the same as earnings per share. Same exact thing, except net income is the whole company.
Okay.
Okay? So this takes the net income from the whole company.
Mm-hmm.
Earnings per share is just if you take all the shares of the company, this is the net earnings per share.
Okay.
Does that make sense?
I think so. So, because every company can have a different number of shares.
Yeah.
Right?
Yeah.
And so but it is a countable number. Like we know how many shares are out there, and then how much the company is making over. Like the denominator would be the number of shares.
Yeah, like a company might have, let's say, $100 million in net income.
Okay.
Okay, let's just say as the whole company.
Okay.
Now you own this company, but you just own some shares of it.
Right.
Let's just say you own one share of this company.
Okay.
So this company has been broken up into all these little squares,
Mhm.
which are shares.
Okay.
Okay. Net income was 100 million for the whole company, but your piece of that net income is $10.
Mm-hmm.
That was your earnings
Okay.
for your share. So for that year, your earnings went up $10.
Okay.
The company as a whole, it went up $100 million. You know?
So is that also related to the predictability thing? Because is that something that you're looking at year in, year out?
Yeah, exactly.
Okay. Okay.
So you say this year it was 100 million for the whole company,
Mhm.
and it was $10 earnings per share.
Mhm.
Same thing, but just broken up.
Okay.
Okay, so $10 this year, and next year it's $10.50.
Mm-hmm.
The next year it's $11. Next year it's $11.60. Next year it's $12.10. You see how this is moving up in a
Yeah.
consistent pattern, and
Yeah.
it's upward moving, and the growth
Yeah.
is predictable. This is the kind of company that you want to buy.
Okay.
The kind of company you don't want to buy is where the earnings are $10 this year, then next year they're $2, and next year they're $20, and next
Okay.
year $5. You know,
Right.
or if it's downward, you know, these kinds of things. You
Yeah.
don't want to buy a company.
Okay. Now, what's the name of that term again? That's per share earnings.
Yeah, or
So-
earnings per share.
Earnings per share.
Yeah.
Okay.
So it's usually called earnings per share, and you'll see it as EPS.
EPS. Okay.
Yeah. So it's one of the most important things that you can look at. But when I say it's one of the most important things that you can look at, when you just see the EPS, it doesn't really mean anything to
Okay.
you. Because if you just say the EPS is $10, that doesn't really tell you much. But you have to see in relation to something else. So if you have the price per earnings,
That's what we just talked about, right?
the PE ratio,
Okay.
this can give you an idea, like the price of the company, the price per share, and then the earnings per share.
Okay.
So this can give you a better idea of comparing one company versus another.
Okay.
Because if you just say this company has $10 earnings per share,
Mhm.
and this company has $3 earnings per share, it doesn't necessarily mean the one with $10 earnings per share is better
Gotcha.
than the other one, you also have to consider another factor like price and see what the relation is.
Okay.
And then you compare these, the PE ratio of one company, the PE ratio of another one, the price per earnings, and then you can get a better understanding of which one is at a better value right now.
Okay, I'm getting that sense with a lot of these variables that like it's one piece of insight, but if you only purchase based on that, then
Yeah,
it's a
yeah,
disaster.
it's not going to really tell you much. And I don't know, these terms might be confusing and it's kind of difficult to kind of grasp when you're not familiar with it. It's kind of abstract. So I recommend that you use like Investopedia, just investopedia.com, and look up PE ratio,
Okay.
earnings per share. They usually have like a 1 minute or 2 minute video, like an animation, and it'll explain it much better than I can.
Well, okay, good, but still, like hearing you talk about it, it gives me some reference and knowing that it's important. If it were just like a term and then I Investopedia, I still don't really know its significance. Like, so I'm happy that you're like telling me about this, even if I do have to go back and like, well, even if I do need to go deeper like by Investopedia, it's still really helpful to hear it from you.
Yeah.
For sure.
And it's basically just your net income broken up into shares. And that's one of the most important numbers. It doesn't matter what your business is. If you run a lemonade stand, you want to know what your net income is after you subtract all of your expenses.
Okay.
You know, so that's important. PE ratio, EPS is another important one. Return on equity, ROE. So these are things you'll become familiar with value investing. And I suggest that everyone like learn these basic ratios and measurements to understand them. And then later you can use a tool like a stock analyzer or something, which just does it for you, you know,
Okay.
and it'll evaluate them for you. But I think it's still good to learn what they mean initially.
Right.
And then don't feel frustrated that later you're going to have to be like calculating all of this stuff by yourself, because later it becomes much easier if you use a stock analyzer or whatever to help you do this.
Okay.
But it's important that you understand the fundamentals in the beginning.
Well, even if I do use an analyzer, I need to be able to go through and actually there are like companies that just use algorithms and things to buy and purchase and instantaneous trading, right? Like, that is a thing. That's not what we do, right? Or we can do. It needs a human touch, doesn't it? To look at these things and catch something or see something that maybe is not fully accounted for. Or,
but no analyzer's perfect, no computer's perfect. So
okay.
yeah, you still need that human touch for the qualitative side to see the brand identity and economic goodwill and things like this.
Okay. Good. Well, and then the last thing there was the market price of the stock.
Yeah, so this is basically one of the last things that you might want to look at. First, you want to find the good company, and you want to look at the fundamentals to make sure it's, what its estimated value is. And then later, you're going to see, what the market price is and when is a good price to buy this.
Okay.
So market price is very important because that will determine what your return is later. You make your money when you buy, so it's important that you buy at the lowest price that you can.
Okay. Is this an order of operations? Like that first you would look at the earnings per share and then, or is it kind of all of a simultaneous thing?
When you do the PE ratio and things like that, you need the price.
Okay.
So you're going to need that to determine the value as well. So it's not necessarily in order like that, but in Buffetology book, Mary Buffett was saying, like, she was comparing this to when Warren was in high school. Maybe he would pick his girlfriend first. You know, he would identify the good company first, or he would pick his girlfriend first, and then he would wait for her to break up with her boyfriend, and then he would swoop in to get her. Or with a good company, you know, you pick your good company first, you analyze it, and you figure out this is the company you want to buy, and then you're just waiting till it hits your buy price, and then you swoop in and buy.
Okay.
You know?
Okay.
So in that sense, I would say, yeah, maybe market price is something like more towards the end.
I was never that smart with choosing girlfriends. Should have taught me this in middle school.
Yeah. What you can learn from Warren Buffett about dating.
Yeah, that's good. I feel good about that. And you know, price is so important, right?
Yeah, price determines everything. It determines your return. So it's very important. And even something as simple as, you know, 10 cents difference with a share price. But if you multiply that over how many shares you own, and then compounding interest effect, you know, it could have a huge effect.
Right. So somewhere in this, it talks about the compounding interest and how even a slight percentage difference, you know, okay, if it's just a one-off, maybe it doesn't feel that big, but if that's something that happens regularly over years, like a single percentage point with compounding interest or compounding rates, it makes hundreds. It depends on how much cash you're dealing with, but hundreds of thousands for the average person.
Yeah, huge difference.
Yeah.
Yeah. And don't feel like you need to just buy at a price because you're getting emotionally involved. You know, wait until it hits your buy price.
Okay.
Don't just watch the ticker and be like, oh, I need to buy it because it might keep going up, you know? So then you buy at a price that you didn't want to buy it at.
See, by talking to you, I can see the connections that were made in the book. Like, you know, so your mind naturally, because this makes sense to you. So you move from price to that. Well, that's actually like in part 2. She kind of mentions that too. For me, it was, you know, why is she talking about this now? But now I understand because the price is so important. Yeah.
Yeah. And you'll experience that as you go along each step of the way as well. Why this stuff's important. That's why I went back and I read or listened to Buffetology so many times, because after I started doing it and had more experiences, this stuff made more sense to me as well. So I recommend going back and listening to Warren Buffett Way, Buffetology series again, you know, not just one time.
Okay. Yeah, because for me, so getting into part 2, like for me it was like totally new idea. You know, by the way, it says, you know, don't let greedy. So this is my words, I think. But don't let greedy speculation guide your price points. Especially, don't pay more just because you guess that the price will go up. So it's nice that you can see why she's talking about this now, because she was talking about how price is important. I didn't catch that at the time. The kind of advisors that you will find, the people, you know, peddling different stocks, they will say something like, "Oh, you better hurry up! Prices are up 2% today. Like now is the time to buy because prices are going up." And this, I think she says, you know, the idea of the train is leaving the station. You better get on now because, you know, it's going up above. And that's a false mentality. You should ignore that kind of talk.
Yeah. So yeah, they have an agenda.
Right.
You know, and they're trying to sell you stocks. And so one of the ways to do this is to make people feel safe. And they tell them everyone else is doing it, everyone else is getting in, you know.
Yeah, these are just marketing techniques.
Yeah.
Like I remember Sea-Doo, the jet ski.
Yeah.
And there is this bandwagoning. You know, people like bandwagoning. And so their phrase was "everybody's doing it."
Yeah.
Sea-Doo, right?
Yeah.
And that it was just so blatantly obvious that like that is the advertising technique they're using.
Yeah.
So bandwagoning, but also limited time offer, right?
Yeah.
Like that's kind of in there too.
Big sales tactics. And a lot of times we convince ourselves of this and we look around and we see other people are saying, oh, the market's really bad now, now's not a good time to get in. And then we're like, oh yeah, better just hold off. Or when people are like, I'm making money, my stocks are going up, everyone's talking about it. And then you feel like, oh, I better get into this. I better start doing this.
Right. Right.
So, whereas actually, you should be doing the opposite. If everyone's talking about it and everyone's jumping in, that probably means they're driving the price much higher. So you should stay out of the market or out of stocks at that time. You should be doing the opposite of them.
Okay.
And then when everything's down and people are like worried and scared about getting in, that's when you should be aggressive.
Okay.
Buying up the stocks.
And you mentioned, and I think somewhere it said too, that Buffett took a step back in like maybe the early 70s during a bull market, if I'm right.
Yeah.
That he had nothing to add to at that time. Can you finish the story?
Yeah. So actually, he gave all the people back their money that had invested money with him, and he gave back the money, and he said, he's closing shop until the market's more favorable. Mm-hmm. And then when stuff went down, actually.
Yeah, by favorable, it's actually less favorable, right? In most people's
so it seems like the opposite. Yeah, so when things went back down, then he entered back into the market, and his investors put the money back with him. And then he started buying up all these companies aggressively.
All these good companies.
Yeah.
That's something that is just now like really settling in. That there's these big macro trends like that you have to like understand, but also fundamentally it has to be a good company because I guess at times a terrible company could also skyrocket in price and you could luck out, but the chances of that are
And I'll try to connect something here with what we were talking about before with PE ratio.
Okay.
The price earnings ratio is basically the price divided by the earnings.
Mm-hmm.
Okay. So if you have the price of the company is $50, and then the earnings are actually $10 per year. So you have the 50 divided by the 10.
Okay.
And you have a PE ratio of 5. Okay? Which is ridiculous.
Ridiculously good or bad?
Well, usually that would mean that the price it's at a really low price.
Okay.
It's underpriced. It might actually be a warning sign because it's too low.
All right.
But anyways, if you have something under 15, this PE ratio, that's what Buffett looked for. Buffett and his mentor Grant, they would usually look for companies that have a PE ratio of 15 or less.
Okay.
So when Buffett entered back into the market when things were down, he could find all these companies that had a PE ratio of around 15 or less. Prior to that, whenever he stepped out, these same companies probably had a PE ratio of 30 or 40 or something like that.
Right.
So when he was seeing all these PE ratios of 30, 40, he knew that the market was, overpriced.
Okay, that makes sense.
So something like these ratios can help you to understand the business and whether it's overpriced, underpriced.
Right. Again, it's incredible how these bits of news or things I remember from the past now make sense to me. I remember around the tech bubble that some not the talking heads trying to sell stocks, but just general news. That was a news issue. The PE, so the
PE
price to earnings ratio,
Yeah.
was just ridiculously high, and that was a sign that these tech companies were grossly overvalued, and that it and I remember there was people that were saying that, but at the same time there were like buddies of mine that were in college and I need to invest next year's tuition now so that I can make a lot of money. Yeah, and a laugh comes out now because it's so ridiculous, but that put them in a really hard time because they were jumping on board on a train that they thought was going up.
Yeah, so if you understand these ratios a little bit, then this can help you in a situation like that. Because there are so many investors that don't learn the basics of these ratios and measurements, and then they can't see this. They can't see what's probably going to happen, you know, or they don't know when to stay out or when to get in. So you'll have the advantage if you know a little bit about these ratios.
Okay. I like too that you said like the same ratio, so a 5 to 1. That could be an incredible deal, like a ridiculous deal, right? Or like you said, if it's that low, it might be a sign of some trouble. So you have to know the other context too, right?
Yeah.
It's interesting that it could.
Yeah, I mean, with anything, usually you have these outliers, and like it could be a bad sign, you know. So
The context and all that other research.
yeah, but mostly Buffett and Grant would look at P ratio of 15 or less to even consider the company to analyze it further.
Okay.
So that might be a good standard to set for yourself. Look at PE ratios of 15 or less, and just look at companies, take their price and divide it by their earnings per share, and just practice a little bit and see what you thought about this company, Walmart, and see what the PE ratio is for that. You can manually do it, and then on the website, it's easy to find. You can find PE ratio.
Okay.
But it might be good to manually just try as well to kind of learn.
And that would be another sign that, well, in the Buffetology it says ignore the hurry up, ignore those sales tactics, right? But that's like one signal to like reassure yourself, okay, wait, this is just a bunch of hype, basically. You would know it from that ratio or some others too.
Yeah, that would help you out a lot to give you confidence about the price. Actually.
A lot of it is about confidence, yeah. Okay. Then she gets into like commodities versus consumer monopolies, which I think we touched on before. But I like these signs of a commodity. That they're like so basically you want to invest in a consumer monopoly, is what she says, and she goes into great detail a little bit later on about what that is. But a commodity is something you want to avoid because there's there's not a good future in that company. A commodity is not a good company to invest in from the Buffett method, right? And so, like, how do you know if something's a commodity? Is that there's no like brand name or brand loyalty. So in absence of that, there's lots of producers, and we just talked about this. Said erratic profits, like profits can go up or down a lot depending on maybe like the cost of iron ore, like, or the cost of oil, or the cost of grain when you're making bread, like bread branding. And it talked about that they have mainly tangible assets. I thought those four things, like, and I'm sure there's more, but those things, I never really thought about. I only knew commodity as like, New York, they have stocks, and in Chicago, it's a commodity trades market, right? So something like potatoes or corn or something, oil, something like that. But here, commodity company is something that creates something that anybody could create, basically. Like a commodity, I always thought was a product rather than a commodity company.
Yeah, and I guess they're just saying it's a commodity-like company, They just use that word to let you know that it's kind of a common thing, and it's not unique. They don't offer a unique product or service that has a protection, some kind of, they call it a moat,
Right?
Or a protection, where we've used Coca-Cola so many times versus the other colas, and they have protection or a moat that it doesn't matter. They can set their price to what they want, and people will still continue to buy Coca-Cola. Doesn't matter if inflation, changes a lot, or if other companies lower their price a lot, Coca-Cola can still keep charging, the same amount or even increase and still keep customers.
Okay.
So that's a true sign of a company that's not a commodity-like business. This one here, mainly tangible assets. I don't know if maybe that's confusing to some people.
Yeah. Well, so the company owns things that are physical in nature.
Yeah. Yeah.
And anybody can get those things that are
Mhm.
physical in nature, usually.
Versus the intangible things, like for Coca-Cola, what would be the intangible things?
The recipe for sure, right?
Yeah,
Brand name.
recipe, their brand name, their reputation,
Reputation.
you know, this feeling that people get when they think about Coca-Cola.
Product associations.
Yeah, so all these things, they're very difficult to measure. You know, it's not a physical thing that you could touch.
Right.
And these intangible assets, Buffett would say that they are inflation or recession proof, you know?
Right, right.
So that's important because they can keep their value. Whereas if you're just selling potatoes and, you know, gas prices go up high and delivery costs go up, you know, this is really going to affect every company that just sells potatoes, you know, and their tangible asset is just potatoes. And they don't have anything that really they don't have any intangible value that separates them according to brand name or reputation or anything like this. So that's why they're saying mainly tangible assets. That's a good sign that it might just be a commodity company.
And then once inflation picks up again, you know, it will be even more important to have your money in a consumer monopoly.
Yeah, or when one of these recessions hits, like, you know,
Yeah.
2008, 2009, you know, you see what happens with just commodities
Right.
versus a consumer monopoly.
Mm-hmm. Yeah,
Consumer monopoly will maintain. I mean, they'll probably still be affected and go down, but then the other companies, just the commodities and the other companies that are just small companies and can't compete, they're just going to die off, or they're going to get swallowed up by the big company and the consumer monopoly. And then after the recession, what's left standing, it's the consumer monopoly.
Okay.
And they've taken up all that market share. So they're even stronger after the recession, where the other companies just kind of fall off.
There's this point too about commodities where eventually you talked about, you know, predictability and charting their profits. Like commodities, like kind of always trend towards zero eventually. Like there might be blips, but eventually, if anybody can enter the market and, you know, duplicate that product, eventually that will happen, right? So there's not like margin over the long term.
Yeah, they don't have a good profit margin.
Yeah, so commodities, that was interesting. And so the opposite of that is a consumer monopoly. And I thought this question was good. Or did you have something else to say, Rupert?
No.
So the question was, if somebody like Buffett, or you, if you have enough money and the best management, could you compete with that company? Like, could you match it somehow, or take market share away from it, or you mentioned
There's a damage, some damage a competitor, things like this.
Right.
Take away their market share, hurt their brand identity.
So you want a company that's kind of immune to that, that doesn't have, like, a competitor cannot enter the market because of things like having intellectual property or brand name recognition.
Yeah.
And she mentioned 3 companies, which you know, I kind of saw it I'm thinking are like kind of archaic. That's my natural thinking, or, you know, like I never would imagine Coke would be a good, in my old thinking, that Coke would be a good investment. I would think, you know, it's Coke, but yet it has all the hallmarks of a great investment based on value investing, if you get it at the right price, right?
Yeah.
So they mentioned Wall Street Journal, Wrigley's, and Coca-Cola.
Mhm.
I thought that was, yeah, like kind of shifted my mentality a lot. That these are companies that you would want based on the strategy if you can get them at the right price,
Mhm.
because they're immune to this damage, like you're saying. Like if people want chewing gum, they're like it's going to be Wrigley's.
Yeah, and she mentioned, I think, that a lot of companies tried to overtake Wrigley's or, enter the chewing gum, kind of market there, but they failed,
Yeah.
So a lot of companies tried to overtake Coca-Cola, but it's just, how can you,
Right. Right.
So he was saying she was saying even with, if you had good management, you had all the money that you needed, you probably still couldn't take them over,
Right.
So those are the kind of companies that you want.
Okay. Yeah, like the Mars company, right? Like these candy companies, like Hershey's. You think, oh, it's just candy, right?
Mm-hmm.
And is how could it possibly be worth anything? Like it's just chewing gum, right?
Yeah.
But yet, like people chew gum, people eat chocolate, people like people read the news and
Mhm.
they turn to the Wall Street Journal, or
Yeah.
they drink a beverage in a restaurant and chances are it's Coke.
Yeah. And even though it doesn't cost that much, it might just be $1 the product, but multiplied by how many people do that, how many people consume that product,
Regularly.
how many times a day they do, the profit margin. It's not a high-tech product, so it's easy to produce,
Right.
and they just follow the same recipe. You want a simple company like this that a lot of people buy and use over and over again.
Okay. Good. And the kind of analogy was you want something that an unregulated water company
Mm-hmm.
that has not been recognized by everyone yet. That when you're choosing a company, you want. I guess the regulations would be. Can you explain that? Like regulations cut profits, right? So, actually the government regulates water companies. So there's not a
think
chance
about if they didn't,
charge whatever they wanted to the city.
And everybody needs water. They'll die if they don't have water for 3 days.
Right.
So start experiencing organ failure and stuff like this. So if you have a monopoly over water, you could charge whatever you wanted.
Right.
Like Monsanto, we had talked about them before. So pretty much, I just read that in America, maybe 90% of corn in America is GMO, and maybe 94% of soybeans GMO, and eventually this crop or their seeds, they overtake other farmers' seeds, and then their crop becomes GMO as well. It becomes the same kind of crop. It overtakes it. And then Monsanto is allowed to sue this farmer for having their crop in there. Meanwhile, it's just blown by wind or something like that.
Really? I haven't heard this.
So, they basically can't be stopped in a way, they just kind of are overtaking the whole, industry.
Yeah.
The seeds, and so a company like that could be a great investment because it's pretty much a monopoly.
I guess that's the thing. Like, you're not investing your money in a business to be a nonprofit. Like, you're trying to make money, and so you want
It's
to.
their duty to make money for the shareholders.
Right.
Yeah.
And so like I feel kind of guilty, like hearing that if I had Monsanto stock, like that just seems kind of wrong. I guess that's the regulated thing, right? If the government were to regulate this GMO market or whatever somehow, then suddenly Monsanto maybe might not be like a profitable
Yeah, it
investment.
would definitely take a big cut out of their profit.
Like just because you're unregulated doesn't mean that you're evil,
Yeah,
right?
yeah.
So
Yeah.
Monsanto, that sounds a little bit evil in that
Yeah, well,
situation, but
I mean, I was just using it as an example to say about a company that kind of has a monopoly.
right, they definitely do.
Standard Oil, Rockefeller's company was another one,
Uh-huh.
that was considered a monopoly, and then it had to be broken up into the different oil companies.
Well,
They could just charge whatever they want once they get a monopoly.
Okay, right. Well, and with Monsanto, I'm from Missouri, and Monsanto's in St. Louis, so I'm familiar with the counter argument all the time. Like, and I know farmers. I drive by farms all the time back home that have Monsanto crops in them for sure, and the yields are through the roof. They're makes the farmers much more profitable. There's lots of arguments for using GMOs and things like that. But then there's the environmental, like the increased pesticides too.
Yeah.
So not to battle about this, but just that even Monsanto, like the benevolent water company that happens to have a monopoly, like it's possible. Monopoly does not equal bad.
Yeah. But the Consumer Monopolies doesn't equal bad company.
Right.
Your point with investing is to make money, but you also have to feel good or comfortable about the investments that you make.
Right. You don't invest into like a drug cartel or something like that.
Unless the earnings are good.
Right.
So then there were 9 questions to determine an excellent business, or 9 questions to determine a consumer monopoly. And I'll just read through them, and then you let me know if there's some question that arises. So number 1, does the business have an identifiable consumer monopoly? So examples were USA Today, Coca-Cola, Marlboro, Disney. So those are some examples there. Basically, most people I think could agree have some kind of consumer monopoly.
Yeah, people depend on those.
And it'd be hard for a competitor to overtake them. Number 2, are the earnings of the company strong and showing an upward trend? This is what we talked about.
Okay.
Usually you're going to look at 10 years, 5 to 10 year history with the earnings. Number 3, is the company conservatively financed? So this means not having a lot of debt, not having long-term debt.
Okay. Kind of talked about how, like when you're determining whether something's a commodity or a consumer monopoly, that debt is an indicator, and that commodities sometimes can take on a lot of debt, buy more land or something to boost earnings temporarily, but that consumer monopolies usually don't need to issue a bunch of debt to boost earnings.
Yes, I mean it's a good sign if they're sitting on a lot of cash, because they can acquire other companies when they need to. They can invest this into their own company. They can buy back shares to increase the value of the company. They can do a lot of things with this cash. And if they run into a hard time, they're protected, because they can use this cash. So that's a sign of good management, good business, system, everything like that. So you want to look for a company with low to no long-term debt. And I believe they were saying that Buffett looks for a company with 1 times the EPS, 1 times the earnings.
Yeah, less than 1 times current earnings.
Yeah, for the long-term debt. So this basically tells you that in 1 year, their earnings, their net income from the business would be enough to pay off all of their long-term debt.
Wow. Yeah. So that would be a nice situation personally.
Yeah.
All right.
Okay, the next one is does the business consistently earn a high rate of return on shareholders' equity? And they say here that the average American business has a 12% rate of return on shareholders' equity, and Buffett usually looks for something 15% or higher. And again, this is something like the BTMA stock spreadsheet, the analyzer, or other analyzer, stock analyzers. They might have some kind of setting in there that will automatically tell you if the company has 15% or more return on shareholders' equity. So it's not something that you will always have to figure out on your own,
Okay.
but it's good to know.
Okay.
Okay, number 5, does the business get to retain its earnings? Okay.
Get to.
For example, let's look at General Motors.
Okay. That's
Okay.
That's
Let's look at Coca-Cola. Let's compare them.
mm-hmm.
So does Coca-Cola get to retain its earnings? Does GM get to retain its earnings? Well, GM every year they have to come out with a new model of car, and they have several models, and they have to update things. So they have a lot of cost for research and development.
Mm-hmm.
They have to make new designs all the time, and they scrap half of them, and then it takes a lot of money to get one design approved, and then they have to go through the process of inspection and regulation,
Mm-hmm.
and environmental costs and things like that. So, do they get to retain their earnings? Probably not as well as Coca-Cola, that just uses the same factory and the same setup and system to make their product.
Right.
Once in a while, something might break down, where they have to replace some equipment. So this would prohibit them from retaining as much earnings.
Yeah. I think if you're focusing, like if you're comparing, like, okay, so Coca-Cola has a factory. Well, I don't think it's a very complex factory compared to like a car factory.
Probably much lower tech than a car.
Yeah, no robots
manufacturing.
picking up
Yeah,
doors and welding and stuff like that.
yeah, and then all the computer systems in the car and the chips and things like that.
Right. So GM would have money going out all the time. Commodities would have, like, companies would also have money going out all the time for like new factory parts. Like that's very like industrial heavy a lot of times, right?
Yeah,
Could be.
Yeah.
But the consumer monopolies, they are so focused on the IP is the real thing, the intellectual property, the recipe, and like it's kind of a low tech thing too. So
Yeah,
they're not. They can keep the money they earn.
yeah. Chewing gum, the cigarette company, these kinds of things. Pretty low tech, pretty simple machines overall. To bottle soda, or I don't personally know, but I'll assume I watch that how things are made.
Yeah,
and
right.
You can see the factories making food products and things like that.
Uh-huh.
It doesn't seem so high tech, but if you see like a car manufacturing plant,
Right.
And then the process to make a car and get it approved, you can imagine it's much more cost intensive.
Number on 6.
Also with 5, we had talked before about so retaining earnings, and then also they could pay out a dividend.
Oh, right.
So basically the company has 2 choices. Whenever they make money, they have their net income, right? And then they can just pay out as a dividend. So they just give the money to the shareholders.
Mm-hmm.
And this we talked about could be good if the company is not very good at managing
Right.
their income. So if they're not very good at managing it and increasing their profits,
At least they're paying out.
then they just pay it out. Yeah. Or they could just not pay out the dividend and then reinvest the earnings into their own business, or they can reinvest into another company. So
Mm-hmm.
it's just an example, but you might have GM and they have some of their earnings, and they say, hey, Coca-Cola is a good company, let's invest some of our earnings into that company. You know, so that can happen as well.
I remember when this happened with Apple, when they paid out dividends for like the first time. This is not an extremely clear memory, but maybe it was just rumblings of them perhaps paying out dividend. But there, I remember, I thought, okay, great, they would pay out some dividend. I mean, people will love that. But there was this counter argument that, wait a minute, they should be investing that in their own, like, we chose Apple because they're, you know, historically good at using their money.
Reinvesting their earnings or buying back shares to increase the value of the stock.
Okay,
Yeah.
okay. So there were a lot of things they could have been doing with that. So
Yeah.
people were disappointed.
Yeah, some companies are really good at reinvesting their own money and buying back shares, which in the long run really increases the value of the stock, and the stock price reflects that, you know, year after year. But other companies are not very good at that, so they just pay out the dividend, or you'd hope that they pay out the dividend.
Briefly in the previous part, they talked about you know, one commodity consumer monopoly company buying another consumer monopoly company, and that plus well, so Apple.
Oh, consumer monopoly. Yeah,
that would be okay.
commodity.
Commodity
Yeah,
would be
yeah,
like
okay.
like double the pain.
Yeah, yeah, yeah.
But the consumer monopoly, one buying another, that reminded me of Apple buying Beats by Dre, which is another thing that, like, actually I've heard the speaker quality is, you know, good, but you know, there's other companies that are better. So, but this, you know, by Dre goes really far, and the other guy I partnered with too, he's a big music guy, I forget his name, but you know, so they have the name brand. So they reinvested the money in their earnings, and they bought another great company. They saw an opportunity there.
Yeah, so that could be a win-win for the shareholders, if it is, to consumer monopolies. Yeah. But in the other way, a consumer monopoly, they were saying if they buy a commodity, they'll end up probably losing their earnings paying for this commodity in the long run.
Right.
So even though they acquired this other company, they're actually going to lose overall in the long run.
Yeah, I guess there would be commodity buys another commodity company, consumer monopoly, but then there's the other, like, commodity buys a consumer monopoly. Pretty good.
Yeah. It'll increase the value overall.
But a consumer monopoly buys a commodity, not going to be good.
Yeah.
I thought that was interesting. I never thought of that.
Yeah. Okay, so where are we at? 6?
6.
How much does the business have to spend on maintaining current operations? So we pretty much covered that.
Yeah.
Yeah. Replacing equipment or the plant, upgrading the plant, and things like that.
Even though these do kind of blend together, it's nice that the way you're laying out these questions, that it's like, that is another, you know, distinct factor to think about. Even though it is part of these other questions too.
Yeah, so maybe each company that you choose, or at the beginning when we first started doing this, I give you an assignment to list out companies that you would think would be a good investment. Then maybe you can run through these 9 questions, ask yourself about these, and if you can find out if they're an excellent business to invest in or a consumer monopoly. And then you could go a step further and look at the PE ratio, the price to earnings, and see if it's 15 or less. You know, and you'll start to get a feel for identifying good investments. Okay, number 7, is the company free to reinvest retained earnings in new business opportunities, expansion of operations, or share repurchases? So, we were also talking about this.
Yeah, free to. Why would a company maybe not be free to?
Well, if they have too much debt,
Okay.
then
Have to repay that.
yeah, they'd have to put that towards the debt probably. So then they wouldn't be free to do that. But if they're sitting on a lot of cash, then they're free to invest this cash in new business opportunities. They can acquire a new company, so expansion, or expand and make a new plant to produce more.
Mhm.
Or they could just buy back their own shares if they feel like the company is underpriced right now.
Mhm. So, yes, and some companies would not be able to do that because they have the debt,
Yeah, I would say if a company has too much debt, you know,
or
or just the size is not big enough of the company.
yeah. Yeah, I guess there could be other reasons too. It's hard to think of like a comprehensive list of all the reasons because like they're various, right?
Mhm. Or possibly the company has a bad reputation,
Uh-huh.
the management's not good, they're in some lawsuits right
Lawsuits,
now,
yeah.
so other companies don't want to be associated with them. Or,
Uh-huh.
you know, there are various things.
Yeah. So if you're not able to like retain those earnings somehow, that's a problem. So you look at earnings and high earnings would be good, but wait, there might be some more to the story.
Yeah, and then the other thing is how good is management at doing this? So
Mhm.
you want good management that's able to do this.
So you use well.
Yeah, yeah. And kind of a flip side to this about talking about good management. Good management is very important. Buffett always said that.
Mhm.
But Buffett always said that you want a company that is so good that a ham sandwich could run it.
Okay.
You know? So,
Yeah, that is kind of like going against, it's like a
Yeah.
contradiction of sorts.
yeah,
Because you need good management, but that good management makes a company so good that.
yeah. But if you can have both, you have the best of both worlds.
Yeah. Okay, interesting.
Okay.
So I could be a CEO of one of these kind of
Yeah.
sandwich.
Yeah. Number 8, is the company free to adjust prices to inflation? So we had talked about this a little bit
Yeah.
with economic goodwill of Coca-Cola, for example. Even if inflation takes off, then Coca-Cola can still raise their prices, and it wouldn't really affect them that much. People would still buy Coca-Cola.
Yeah. And maybe too, like the cost, like how much does the cost of their manufacturing go up if the prices are inflated? Because a lot of what they're making money off of is the recipe, right?
Mm-hmm.
Like the water that goes into Coke or the syrup, like inflation won't jack those prices up that much relative to the price of the Coke, right?
Yeah.
So yeah, they can just kind of set the price.
Mm-hmm. And they have enough of a profit margin
Yeah.
where they could do that. Yeah.
Yeah.
Some cushion. Number 9, will the value added by retained earnings increase the market value of the company?
I guess we've kind of talked about it already, haven't we? Or maybe
Yeah.
I'm blending them together myself. I hope I'm not like taking 9 things and turning them into one.
Well,
Like,
for example, if the company has their earnings, their EPS, and if they take this earnings and they buy back shares of their own company, then the value will probably increase over the next year or following years. So this shows that the value has increased by their retained earnings.
Okay.
They kept these earnings and they used it in a positive way
Mm.
to increase the value of the company by buying back shares. Or they take their earnings and they reinvest in another good company and they increase their earnings, okay, or their profits over a long time. On the other hand, if the company has to take this retained earnings and they have to put it towards debt, or, well, that could still help out with earnings. But if they have to take this money and they have to constantly replace equipment that breaks every 6 months, then this is not,
It won't come out in the price of the stock.
it's not showing the value increasing in the stock yet.
I felt like that with Apple. I remember they were just sitting on piles of cash,
Mm-hmm.
but that doesn't seem like it's utilizing the money very well. But I guess that's still, maybe that's kind of an anomaly. Like the company keeps the money and the stock price goes up at the same time. That's what you're looking for.
But for instance, Apple might be holding that money and waiting for the opportunity, and when the stock goes at a really low price, then they're ready with that cash to buy back, repurchase their stocks, and then they'll increase the value of it.
Okay.
So that doesn't necessarily show that there's something bad there if they're just sitting on a pile of cash.
So increase the price of the stock could be from the company buying their own stock, like a buyback that would raise the price of each.
Yeah.
Or it could be, the company is perceived as being worth more, and could it also be that people invest more so the price goes up? Like it wouldn't have to be a buyback, right? There are other ways that the price can go up.
Yeah.
That would count towards this.
Well, they're talking about value though. So value is different from price.
Okay. Yeah. I agree with that statement,
Yeah.
but I'm a little bit slow still.
So the value, basically, let's take the company Apple, okay? And they have their assets and they have their liabilities. You have your balance sheet. And at the end, you'll come out with the assets. If the assets are more than the liabilities, that'll be what your value is in the company. So this balance sheet will actually give you the value of the company.
Gotcha.
What is the company actually worth if they have to liquidate today?
Right.
If they have to sell off all their assets. Plus, maybe they have some intangible assets. Their logo, the Apple name, this brand identity. If some other company were to buy them,
Right.
what would they be worth today if they had to sell off the company?
Okay.
So that would be their value,
value.
the actual value.
I think I was thinking price.
Yeah. So here's the actual value of the company, and then the price just fluctuates according to people, their emotions, and
Right.
whether they're buying, whether more people are buying than selling.
Okay.
This will make it go up and down.
So retaining money increases the value of the company.
Yeah.
My mind was thinking price. That was confusing.
Yeah. And I think that confuses a lot of people. They confuse the value and the price.
Okay, that makes sense. Good. So those were 9 things, a line of questioning to help you identify consumer monopolies. Good. And then the fourth part. There were just a few small points here.
Are we gonna make it to the fourth part?
You want to?
Yeah. Let's conquer through it.
So this was just highlights things that hit me. So buy when it's bleakest, and I'm more of the get on the bandwagon like automatic mentality, jump on when it's on the way up, ride it all the way up, right? Get on the ride when it's on its way up. That's my instinct, right? But no,
not anymore, right?
I hope not. Yeah, I mean it's still an impulse. But buy when it's bleakest. That's a good company when it's at a bleak time.
Yeah.
And I thought that again the resorts, the ski resort in a year without snow, that's the time to buy, because when everyone else is freaking out oh no, there's no snow, the ski resort, global warming or something like that, that might be an actual thing,
But you did your homework and the pattern, and this company is always at a cheaper price at this time,
Right.
Every 2 or 3 years, whatever.
Mhm.
So you're ready to buy it up, like Buffett looking for when his girlfriend breaks up with her boyfriend.
Right.
Yeah, you're ready to buy up that company. That's ready. And buy when things are at its bleakest. Also, I think I mentioned before, Buffett had a quote that says, "We like to buy good companies, when they're on the operating table."
Right. I've heard that before.
Yeah, so something bad happened, but it's not something permanent, and that's when you want to buy them up, when they're in that position.
Yeah, operating table, not the deathbed.
Yeah. Also in Buffetology, Mary Buffett mentioned American Express. Did you recall that story?
No, I don't.
So anyways, I don't remember the year, a long time ago, American Express, they had some businessman, and he had cooking oil, and he had so many barrels of cooking oil stored stored in some storage, and American Express, without properly checking that it was oil inside, they issued money to him for the value of all these barrels
That
of
was
oil.
the collateral.
It was a huge amount, yeah. And what actually happened was he defaulted or whatever on the loan, and they went to seize the asset, which was all of this oil. And when they opened it, they found that he had just filled all these barrels with seawater. So they lost a huge amount of money, probably some kind of lawsuit or whatever.
Right.
And the company really went down. The company was on the operating table, and Buffett saw the opportunity. He knew overall the management was good. It was a big company. It's been around a long time, and he bought it up and made a huge amount of money.
Yeah, it's a great example. I think too, though, like on the operating table, I would question. He knew the management was good, but I would question the management or the practice. Like if there's that one example, maybe there's others. But I guess he had done his homework so well that he knew that that was an aberration. That this was not something that happens a lot. There's an exception to the rule of them being a good company.
Yeah, and at the same time, he might have also looked at the PE ratio and other measurements like that to see how undervalued it was.
Okay.
Because he might have actually seen the value was actually here, and the price was down here.
Okay.
So even if the management was not perfect or not as good as he would like, if the actual price is way less than the book value, or if they liquidated and sold off all their assets, and the value of the business is much more than the price, and it still could be worth the investment.
All right, so like this story was just like the guy's oil, like the money loss from that could have been like a drop in the bucket actually, but people overreacted.
Yeah, I'm not exactly sure how much of the
okay.
percentage of the business it was, but anyways, it had a huge effect on the stock price when the news got out. Yeah, so that often happens, and that's to our advantage as value investors.
Okay.
Because when the media gets a hold of things, even if the story isn't that significant, like as far as what's going to happen with the value of the company, people overreact and people sell off their stock, and then that's when value investors can come in and buy at a bargain.
Okay. Then the last thing from this that I found really important or very enlightening was the idea of jumping from one strategy to the next. Like I guess people are kind of urged to do that. Like they might buy a good company based on value investing, and then like it goes down slightly, and then freak out, this is not working, and then I jump to the next one. I think I would do that. Like sell. I'm the type of person that mistakenly, if I don't have your advice, and if I'm not studying this, my nature would be to sell when it's low. Like, oh no, stocks are tanking, I'll sell now.
I don't know what to say to that. I think that's the biggest issue with why people lose money in stocks.
Right.
And I have customers that buy my analyzer or use my investing service, and that's one of the biggest problems. I always have people that are very anxious and they're not patient, and you could just tell that it's going to be very difficult for them to be a good long-term investor because they're always fighting themselves, and they just want to get a gain quickly. And if things don't work out perfectly for them within 1 week or a month, then they're off to the next idea. And it's very difficult for a person like that unless they actually realize that they're just going to have to wait and just focus more on the value and don't worry about this price going up and down that much, unless it's to your advantage, and stick to one thing. find the system that works. If value investing makes sense to you
Mm-hmm.
and you think it's a logical approach and you make that decision in the beginning, then stick with that. And if you say that if you figure out the P ratio of under 15 is a good number and you have these other metrics, then stick with that. Learn how to say no to opportunities as they come up,
Okay.
unless they fit exactly what you want. Don't convince yourself to buy something that you don't want to buy, because you might end up holding it for a year or 5 years or 10 years. You might have to.
Okay. So yeah, if you do your homework, I guess you could sit back and have that confidence.
Yeah.
But also, I think if people or if anyone has some success with this, I assume that you've had success with it. Even your story about having to hold on to Exxon for a year. You started off talking about it like it was not a success story, but to me that it's better than parking your money in a bank. That's for sure.
Yeah.
It's better than a lot of CDs or a lot of bonds would have paid for sure.
Mhm.
So that success will kind of breed confidence,
Mhm.
I think, and then I can understand how a new person who sees that if it were to dip right away, unfortunately, or just you time the buying wrong slightly, like you did with Exxon, it wasn't at the bottom of the trough of the bust or whatever
Mhm.
for oil,
Yeah.
and you're not going to get the trough every time. You're not it's not going to be perfect every
Exactly.
single time. But having the confidence to see that through, and then having that success of making money over the long term, I think that will breed confidence.
Mhm.
I need to hear this because otherwise I may waver.
And I was very anxious at the beginning,
Okay.
and I was watching the ticker. I was watching it go up and down in the beginning, and I didn't really have a sense of how much is a stock supposed to go up and down in a day,
Mm-hmm.
or minute by minute, or within the week. I didn't really have a feel for that,
Okay.
But then after a few months of trading, I had a much better understanding of how the market moves.
Okay.
And then I had more confidence. And then years later, having to hold a stock for like a year, it's nothing to me.
Okay.
It's just because I know that I'm confident that I bought it under the estimated value,
Right. Right.
And I know this company is going to be around for 10 years, and they're still going to be doing the same kind of thing. Or I'm pretty certain of it. So I don't really have something to worry about. But at the beginning, I understand how anxious you
Right.
can be.
Right.
So yeah, I'm just trying to let you know right now. Don't worry. Just do your homework at the beginning. Buy the best company that you can at the best price that you can. That's under the estimated value, and then you don't have to sweat that if the price goes down. Don't worry about it.
Right. I mean, it is possible that you made a miscalculation, right? That does
That's why you
happen.
add the margin of safety. So
Okay.
even if you screw up, you still have that margin of safety, a big enough margin of safety.
Okay. And just hold tight.
Yeah. Because the worst thing you can do is sell a good company just because the price went down.
In a panic. Yeah.
Because a lot of people are panicking and selling it. That's the worst thing you could do, is sell it after it had a huge drop.
Right. Okay. Well, she saved it for the end of the book, and it was great. So, we're talking about not selling and when it goes down, but also just keeping the same strategy. And part of that is waiting for the time to buy, and then being confident until it's the time to sell.
Mm-hmm. And that doesn't mean that you can't change your strategy over time as you learn new things and
Right.
adapt and
Okay.
become more efficient at something. But don't jump from one thing to the next.
Impulsively.
Figure out, do your homework, and buy something that is good for you at that time, and figure out an investing system that works, and make your decision before you need to make the decision. And then, stick with that the best that you can. Don't go over your boundaries or accept less.
Okay. Yeah, that's very useful.
It says wait for your perfect pitch, So,
I will do that.
Okay.
I can do it.
All right, so we'll finish up there with Buffetology. As I said to Clayton about possibly taking that list of companies, this could be another assignment.
Okay.
You could take the list of companies that you had made before, or you can add new companies that you think would be a good possible investment. Go through the 9 questions that they give you if it's a consumer monopoly that they give you in the Buffetology series. And then after you figure out if it's a consumer monopoly, you might look at the price earnings ratio and see if it's at 15 or less, what Buffett looked at, to find out if there are any good companies at a good price that you want to buy. And then you can use your virtual trading account to purchase some of those.
Good deal.
Any questions about that?
No, I think that's perfect. So I'll try to do that.
Okay.
Was there any other homework that I should work on?
No, I mean, if there's anything else in here that you learned and you want to apply, like if you go through that list of 9 questions for each stock and then you see the PE ratio, and if it passes, if you have one company that passes most of those questions or all 9 of those questions, and then you find the PE ratio is under 15 or lower, and it passes that, then you can move on to another measurement or criteria, like the long-term debt.
Gotcha.
Does it have low long-term debt or 0 long-term debt? Is it 1 times or less the earnings?
Okay.
Then you could do that.
Sounds good.
And you can use like MSN Money or Yahoo Finance, Google Finance to find all these numbers: PE ratio, the long-term debt.
Okay. So even though, like, eventually, I hope to use an analyzer to help me through this process. Right now, like, I'm kind of like going to get my hands dirty in this, and really experience it and find out, how to pull these pieces of information, think about them, and analyze it manually.
Yeah, manually, I think would be the best first, so you understand it.
Sounds good.
And then later you can use the analyzer after you already understand.
Sounds perfect. Yeah.
Okay. Sounds good. All right.
Thanks, Grant.
Thank you, and we'll see you next time.